Hey, I'm Jonathan Wild, and we cover how to account for transportation costs. When we talk about transportation costs, we're just talking about shipping goods from point A to point B. Now, this gets a little more complex when deciding who is paying for the shipping costs and who has the risk of loss during the shipment. Is it the buyer or the seller? This is usually based on at what point ownership of the goods transfers from the seller to the buyer. In business, the point of transfer is called the F.O.B point, which stands for free on board. So first, let's cover F.O.B shipping point. Under F.O.B shipping point, the buyer accepts ownership of the goods when they are shipped from the seller's place of business and has the risk of loss in transit. So, if the goods are stolen during shipment, the buyer takes the loss. Under F.O.B shipping point, the buyer also pays the shipping costs. To record the buyer's entry for a $300 freight or shipping charge, we debit merchandise inventory for $300 and credit cash for $300. We debit merchandise inventory because the account is supposed to include the cost to buy the goods, ship them to the store, and make them ready for sale. And we credit cash to reduce that asset account. The other shipping terms is F.O.B destination. Under F.O.B destination, goods transfer to the buyer when the goods arrive at the buyer's place of business. Therefore, the seller has the risk of loss in transit and does not record revenue until the goods are delivered. So if the goods are stolen during shipment, the seller takes the loss. Under F.O.B destination, the seller pays the shipping costs. To record the seller's entry for a freight or shipping charge, we debit delivery expense and credit cash. Delivery expense is reported as a selling expense on the seller's income statement. To wrap it up, the F.O.B point determines how transportation costs are recorded and who has the risk of loss during transit.